Welcome to the KPC Smart Money Podcast with Kevin and Karen Christ. You know, Karen, we need to talk about a subject that really we haven't had a whole lot of in the last 10 years or so, and that's market volatility.
Correct.
Navigating market volatility is what we're going to talk about. We're going to talk about that in two parts. So this is part one, and you know, we sent out to our clients, we sent out an article about this, and we got some positive responses, and basically, in a nutshell, said, you know, thanks for getting us to think about, you know, what's really happening here.
Mm-hmm.
And because at the end of the day, you have to decide whether you want to be in the stock market or not. And that was an easy decision the last 10 years because it just up, right?
Well, people who were in the stock market in the last 10 years did quite well.
Yes,
you should have done quite well.
Yep, yes, they did. So really what's happening right now with the, you know, like today, before we recorded this, you know, the market was up. Yesterday it was down, you know, so, and this year hasn't been very good, quite frankly.
But
I think
what we do know is it's volatile right now. More volatile than people have been used to seeing in a while.
But Karen, what people have to understand is that is the nature of the stock market.
Correct.
Is the ups and downs. You know, when it's up, everybody's gets euphoric and they get real aggressive in their 401ks and their IRAs, right? And so when things start to get volatile and we have, you know, a bad week, like one bad week, everybody's going, okay, this is it.
Right.
Bear market. Right.
And it's lasted a little longer than that now, but basically volatility jolts investors back to the harsh reality that market pullbacks happen, and they happen regularly. It's just part of the investing cycle.
That's right. And U.S. stock market has endured many challenging events since 1980 and has averaged double-digit annual returns despite these challenges. You know, things are a little bit differently. You know, our clients, I would say, we've never figured out what the average client age is, but I would venture to say it's upper 50s, probably even in the 60s. A lot of our clients, we've had a ton of people retire in the last couple of years.
Yes.
Right? So things change and you have to make adjustments, but panic selling we have to avoid.
Yes.
Right? That's the key to that. So, you know, some people remember 1987, Black Monday. We're going to talk about that in a second. But, you know, panic-driven selling may alleviate short-term fear, but investors may also miss out on the market's strongest days and reduce their long-term returns.
Right. And, you know, we saw that with people who pulled out of the market because of COVID. They missed a substantial upswing. So basically, let's just talk about the past and put that in perspective with what's happening now. And yeah, we get it. Market volatility makes investors nervous. Logically, though, we know markets go both up and down, and reaping the rewards of investing comes with risk. That's easy to remember in times of growth, but it's much harder when market volatility arrives and we feel compelled to take actions based on emotions, not logic.
You know, and a lot of you listening here, especially if you're already our clients, you've experienced some tumultuous events in the past 40 years, including the 1987 Black Monday stock market crash that I alluded to, the terrorist attacks of 9/11, you know, the 2000 and 2009 global financial crisis. You know, a lot of people call that the meltdown, right? The huge recession. Historians will certainly add the COVID-19 pandemic of 2020 and also a list of remarkable events that have caused severe market volatility and prolonged periods of uncertainty.
Yeah. Now, you know, these events, they all had different effects on our economy as well as just our, you know, our daily lives. Here's what they share in common, though. We have always come through them. Sure, they hurt while they're happening, and some of them took longer to recover than others, but our markets and our economy have always come back stronger and better than ever before.
So markets, like people, do not like uncertainty.
Correct.
Boy, we found that to be
Yes.
true, right? So we had some people say, "What are you doing to protect my retirement?" You know, those words, right?
Yes.
We cannot predict when market volatility will occur or exactly how long it will last. You know, Karen, I heard a saying the other day. I was talking to a third-party money manager, and you know, she was going through all these different graphs, and we were talking about it. You know, the difference between market timing and long-term investing and so on. And she said, I love this statement. She said, "The Hall of Fame of market timers
Mm-hmm.
is an empty room."
Correct.
Right? So, you know, if everybody or if one person knew exactly when volatility was going to happen, everybody would give their money to them.
Right. Or consistently. There's some people who have maybe pulled off, guessing market timing once or twice, but then failed miserably the next time. So
you know you've read it was big favorite
Harry
of your
Dent.
dad. Yeah, you know
Uh-huh.
how'd you know I was going to say
Because
that?
I was thinking the same thing.
Well, he's appeared again in the news, and it's the end of times now,
Yeah, I
and
know.
you know, and get ready and hold on to your wallet. You know, and he said that in 2015. He said that in 2011. You know, here we go. You know, it's a stock market crash, and it didn't happen. So
Right.
I think to be a guest on Fox Business News or CNBC, you just have to be right once.
Yeah, well,
you know,
well, so,
or give them a lot of money to be on their shows, or somehow have a great publicist to get into the magazines, right? And
Right.
and the emails.
but the one thing we can look at is history, right?
Right.
So the decade-long bull market of the 2010s eased the pain that many investors felt coming out and still remembering 2008, 2009. Now, reality came crashing back in early 2020 as COVID spread globally and the markets plummeted in response. The downturn left investors searching for reassurance that everything's going to be okay eventually. Fortunately, that reassurance is easy to find. We'll just take a quick look at the history of the U.S. stock market, and that gives us 3 reminders of the true nature of volatility.
Okay, so volatility is not new.
Right.
It seems to like that to a lot of people right now because we've had like the best bull market we've ever had, or the longest bull market we've ever had. So between 1950 and 2020, we have experienced 36 market corrections. That would be a market pullback of 10 to 20%, which has already happened this year.
Yep.
It's approaching, I think, so right around 12%.
Yeah.
Just under 12%, or an average of one every other year or so. So here's the good news. 3/4 of the market corrections from the last 50 years never turned into serious bear markets. So I hope that's true now.
We do.
Well, not according to Harry Dent, but anyway. Most were short-lived, lasting 3 months or less. Now, the takeaway here is that markets have recovered following a correction before, and they will do so again. So some may take longer than others, but history shows us that it's taken an average of 4 months to recover from prior corrections.
Yeah. So, since we're talking about history, let's go ahead and talk about some of the corrections. And a lot of you listeners are going to remember these, but we want to talk about the resilience. What happens after these market adjustments? And so here's just a few. October 19th, 1987, stock market crashes on Black Monday. From 1990 to 91, Iraq invades Kuwait, eventually leading to U.S. involvement, and the tech bubble burst. September 11th, no one can forget that one with the 9/11 attack. And then March 20, 2003, there was a U.S.-led invasion to Iraq, which led to the Iraq War. So a global financial crisis hits hard for individuals and businesses in that 2008-2009 range, And then here we go, 2018, trade war begins with U.S. and China. We've already talked about COVID. So there's lots of examples out there of bad stock market news and what happens with volatility. But at the end of the day, the message is our stock market is resilient. It comes back. Hold on. But we've got a few other things. We weren't really done with this topic, Kevin. So
yeah, we're running out of time. We like to keep these short. So, we want to get into, market timing. Does it work and all of that? And what do you do about all these things when people start to get nervous? What do we do? Well, next week we're going to continue this topic of navigating market volatility. So we'll be back next week. Thanks for listening.
You've been listening to the KPC Smart Money Podcast with Kevin and Karen Christ. To listen to more episodes, visit kpcsmartmoney.com. You can also find the KPC Smart Money Podcast on Apple Podcasts, Google Play, Spotify, and Stitcher.
KPC Financial Solutions is an independent financial services firm that utilizes a variety of investment and insurance products. Investment advisory services offered only by duly registered individuals through KPC Financial Solutions, LLC, a registered investment company. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying ability of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should be construed as advice designed to meet the particular needs of an individual's situation. KPC Financial Solutions is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by KPC Financial Solutions. Hypothetical examples have been provided for illustrative purposes only. It does not represent a real-life scenario and should not be construed as advice designed to meet the particular needs of an individual's situation.